Hello everyone, today is Tuesday, March 10th, 2026. Hope everyone is doing well mentally and physically. Welcome to another episode of Tax and Accounting Ride Along, brought to you by Sands Virtual Enterprise, LLC, your go-to dose of straight-talking tax and accounting insights for small businesses and the everyday taxpayer and the general public. Today, this episode touches on the IRS penalties associated with failure to file required tax returns. The penalties are amplified based on whether or not you have a balance due to the IRS or state, and typically it takes a full and complete preparation of your tax return to determine the exact taxes due. With the March 16th tax filing deadline for S corporations and partnerships fast approaching, these insights couldn't come at a better time for making an informed tax filing decision. So without much further ado, let's crank it up and get straight to it.
I'm so thrilled to have you riding shotgun with us today, right here on the Tax and Accounting Ride Along podcast.
Glad to be here.
Yeah, we're gearing up for a fascinating and honestly slightly terrifying journey into our latest source material.
Oh, absolutely. Terrifying is definitely the right word for it.
Right. Because today we are looking straight into the belly of the beast. We're talking about the IRS penalty and interest system.
The fun stuff.
Exactly. I mean, if you have ever felt like the IRS has you trapped in this washing machine that just will not stop spinning, well, this deep dive is exactly for you.
Yeah, we've all been there, or at least we know someone who has.
For sure. So our mission today is simple, but incredibly important. We are going to map out the absolute costliest tax penalties, break down exactly how they compound and grow into these just monstrous amounts, and most importantly, give you the exact strategies you need to avoid them altogether.
It really is the perfect metaphor, isn't it? The washing machine. Because the source material we're looking at today literally calls it a never-ending spin cycle.
A spin cycle.
Right.
Yeah.
You get a notice. You think you've paid what you owe. You think the cycle is finally over. And then boom.
Another notice.
Exactly. Another notice arrives, taking you for one more spin, all because of newly accumulated interest.
Oh, man, that's rough.
It is. But to really understand how to stop that cycle, we have to look at the foundational premise outlined in our text. This entire debacle, all of it, stems from one primary issue: unpaid tax balances due.
Okay, let's pause there because it sounds like, such an obvious starting point, but it really dictates everything else we're going to talk about today.
It's the anchor for everything.
Yeah.
I mean, if your taxes are paid up timely and sufficiently, the IRS is rarely eager to chase you down.
Right.
Just think about it from a resource allocation standpoint. They're not eagerly hunting down taxpayers who simply forgot to file their unfiled tax returns just so they can issue them a refund.
That's a great point. They want the money.
Exactly. They are looking for the unpaid balances. That is the trigger for the spin cycle.
Okay, let's unpack this. Because the very first major threat our sources highlight is also the most common and frankly the most frustrating because of how completely avoidable it is.
Yep.
The text points to the failure to file penalty. So for someone who might, just avoid filing because they know they owe money and they just can't pay it, how badly does that actually hurt them mathematically?
It is absolutely brutal. The failure to file penalty is assessed whenever you failed to file your taxes by the original due date or your approved extension deadline. And it accrues at a massive 5% per month.
Wait, 5% every single month?
Every single month.
That sounds like it would spiral out of control almost immediately.
Oh, it does. Which is staggering when you really sit down and model out the numbers. I mean, 5% a month means that in a very short 5-month period, this penalty easily peaks at a whopping 25% of the total taxes you owe. Yeah, just 5 months. You blink, half a year goes by, and suddenly your initial tax bill is a quarter larger than it was just from this one specific administrative penalty.
So putting that into practice, it sounds like the golden rule here, and this is straight from the source material, is that you must always file your taxes on time, even if you have a tax balance due and your bank account is completely empty.
That is the single most important behavioral takeaway here.
Yeah.
I mean, human nature says, I don't have the money to pay this bill, so I'm just going to hide the paperwork in a drawer until I do.
Out of sight, out of mind.
Right.
Oh.
But as the text points out, if a tax balance is due today, it will still be due tomorrow or next week or whenever you eventually file.
Yeah.
By hiding it in that drawer, you instantly trigger that 5% monthly penalty. You compound your financial pain immediately.
That brings us to a really interesting comparison in the text. There is a distinct difference between failing to file and failing to pay.
Huge difference.
Right. So if someone files on time but genuinely just doesn't have the cash to clear the balance, what does the failure to pay penalty look like?
Well, first, we have to establish a core rule this text makes very clear. An extension to file your taxes does not grant you an extension to pay your taxes.
Say that again for the people in the back.
An extension to file is not an extension to pay. So whenever you fail to pay the taxes due by the original deadline, you incur this failure to pay penalty. Now, it also eventually peaks at 25% of your unpaid taxes, just like the failure to file penalty.
Okay.
But the massive difference is the velocity. The failure to pay penalty accrues at a much, much slower pace. It accrues at 0.5% per month.
Half of 1%.
Exactly.
That is a massive difference from 5%.
It's exactly 1/10 of the speed. To put that in perspective, the source notes that at 0.5% a month, it would take you 50 years to hit that 25% cap for failing to pay.
50 years.
50 years. Meanwhile, failing to file hits that exact same 25% cap in just 5 months.
That is wild.
If we connect this to the bigger picture, it tells us a lot about how the IRS operates and what behavior they are trying to enforce. The system is designed to heavily penalize the act of completely ignoring the filing deadline.
Right.
They view ghosting the IRS as a much more severe infraction than simply not having the liquidity to pay the bill immediately. They want the data. They want the return filed so the liability is established on the books and the assessment is official.
That makes sense.
Yeah, so if you file on time but can't pay, they slap your wrist with a 0.5% penalty. If you don't file at all, they bring the hammer down with a penalty 10 times larger.
It is essentially a massive behavioral tax. They are taxing your procrastination or your fear of facing the final number. So for everyone listening, file the return or file the extension, even if your wallet is completely empty.
Exactly. And while that 5% a month sounds painful for an individual return, the math gets significantly more aggressive when we look at business entities.
Oh, I'm glad you brought that up because the stakes change completely here.
They really do.
Before we dive into the business numbers, let's be crystal clear on the terminology based on our sources. We are specifically talking about S corporation tax returns and partnership tax returns.
Right.
S corporation tax returns and partnership tax returns have their own entirely separate universe of rules compared to your standard individual returns. So why is the timeline so different for these entities?
The most critical rule in that universe is the calendar. The original calendar year due date for S corporation tax returns and partnership tax returns is March 15th, not April 15th.
Okay.
March 15th.
Okay, so a whole month earlier.
Yes. And March 15th deadline isn't just a random date the IRS picked to be difficult. It exists because these are pass-through entities.
Meaning what, exactly?
Meaning the business itself generally doesn't pay the income tax.
Yeah.
The partners or shareholders do.
Yeah.
So the IRS needs that business data finalized a month early so that the partners actually have their K-1 forms in hand to file their personal returns by the April 15th deadline.
That makes perfect sense operationally. But missing that March 15th deadline seems to trigger something the text describes as incredibly unforgiving. What is the one-day late rule?
Yeah, I consider it one of the most draconian timing rules in the entire tax code.
Really?
Oh, yeah. The text breaks it down perfectly. A single day late counts as an entire month late.
No way.
Yes. There is no prorating. There is no grace period. If your S corporation tax return is due March 15th and you file on March 16th, the IRS considers you a full month late.
Wow.
And it cascades from there. All it takes is to be one single day past a monthly milestone and the IRS hits you for an entire additional month's penalty. It's a cliff. And if you step 1 inch over the edge, you fall the entire way.
And what waits at the bottom of that cliff? Because unlike the percentage-based penalties for individuals, our sources show this is structured very differently.
It is a flat per-person fee that scales aggressively. The late filing penalty for S corporation tax returns and partnership tax returns is $245 per month per partner or shareholder for up to 12 months.
Man, the per-partner aspect seems like the real danger zone here. It turns a minor administrative oversight into a catastrophic financial event for a small business.
Oh, absolutely.
Let's walk through the exact real-world example provided in our source text just to make this tangible for you. Imagine you have a small business structured as an S corporation. There are just 3 partners. Business is busy, paperwork gets lost in the shuffle, and you end up filing the S corporation tax return 4 months late.
Happens all the time.
Right. And in the grand scheme of running a business, 4 months might not feel like a lifetime.
But to the IRS, it is a gold mine. Let's do the math on that scenario. You have a $245 penalty per month. Multiply that by 3 partners. That is $735 a month in penalties. Now multiply that by 4 months late. That is a massive $2,940 penalty. Nearly $3,000 for a 4-month delay.
And the most shocking part of this is that the penalty applies regardless of the company's profitability, right?
Absolutely. This has absolutely nothing to do with whether the business actually owed any income taxes. This is strictly a late filing penalty. You could have a business that operated at a total loss for the year, owing $0 in income tax, and you will still be slapped with a $2,940 penalty simply because the paperwork arrived 4 months past the March 15th deadline.
That is just brutal.
It highlights why maintaining pristine administrative hygiene is just as important as generating revenue. You can work incredibly hard to build a profitable business, only to have a significant chunk of that profit wiped out by a completely avoidable compliance penalty.
So knowing all this, how are we supposed to proactively handle our money throughout the year to stay out of the crosshairs? The deep dive sources point heavily toward estimated taxes.
Yes, very important. The general rule of thumb mentioned is the estimated tax threshold. Basically, if you are expecting to have taxes due in excess of $1,000 for the year, you are required to make estimated tax payments throughout the tax year.
It's a major cash flow paradigm shift. We are so conditioned by the automated W-2 withholding system that when transitioning to self-employment, building estimated taxes into a quarterly operating budget is often the hardest operational hurdle to clear.
Oh, for sure, because nobody's doing it for you.
Right. If you don't proactively manage that liquidity, you are setting yourself up for a crisis.
Because nobody is withholding those taxes, the responsibility falls entirely on your shoulders. The text emphasizes how critical it is to file your quarterly estimated tax returns and make the appropriate payments every single quarter.
And logically speaking, it is vastly superior tax planning anyway.
How so?
Well, paying a little bit at a time throughout the year is manageable. It becomes a standard line item in your monthly or quarterly budget. Trying to scrape together the cash to pay a massive lump sum tax liability all at once at the end of the year, often right around the same time you are trying to fund your business for the new year, is a recipe for disaster.
Definitely.
And if you fail to make those estimated payments, you trigger the failure to pay proper estimated taxes penalty.
Let's look at another angle. What happens if you do file on time and you do try to pay your estimated taxes, but you just make a mistake? The tax code is notoriously complex. The text outlines something called the accuracy-related penalty. How wide is the net they cast for this one?
The net is cast incredibly wide. This penalty can be assessed if your taxes are prepared incorrectly, and it covers a whole spectrum of issues. It could be a simple math error, it could be deemed incompetence, it could be negligence, or it could be substantially understating the taxes you actually owe.
Wow.
Yeah, if the IRS determines any of those infractions have occurred, they may charge a 20% penalty.
Wait, is that 20% on the entire tax bill for the year?
No, and that is an important distinction. That 20% penalty is levied directly on the specific portion of the unpaid taxes that are related to that exact inaccuracy infraction.
Okay, that makes more sense.
Right, it's 20% of the shortfall caused by the mistake. Still, 20% is a hefty premium for misunderstanding a deduction rule or having a spreadsheet formula break.
It definitely is. But the system isn't entirely without mercy, is it? Our sources talk about IRS penalty abatement.
Yes. What's fascinating here is that the IRS does have mechanisms to forgive some of these penalties. As bad as all these penalties seem, the 5% failure to file, the $245 per partner late fees, the 20% accuracy penalties, you may actually qualify for an abatement if you meet certain criteria.
Which are what, usually?
There are generally 2 main avenues for this. First is a history of compliance, often referred to as first-time penalty abatement. If you've had a clean record for the past 3 years, the IRS might waive a failure to file or a failure to pay penalty as a one-time courtesy.
And the second avenue?
Demonstrating reasonable cause. But it is important to note that reasonable cause is a very high bar. It isn't just saying, hey, I forgot, or I was too busy.
Right, my dog ate my tax return.
Exactly. It usually requires proving that despite exercising ordinary business care and prudence, you could not meet your tax obligations. We were talking about severe events like a natural disaster destroying your records, a serious illness, or the unavoidable absence of the taxpayer.
That brings to mind a timeless piece of wisdom from our author. Prevention is better than cure. Fighting for a penalty abatement takes time, effort, and often professional representation. It is infinitely wiser to just not put yourself in that situation to begin with.
Absolutely.
Yeah.
Because while you might be able to get a penalty abated, there is a much darker cloud lurking behind it. And that brings us to the most overwhelming part of this entire system.
Oh boy, here's where it gets really interesting, and by interesting I mean terrifying. The ultimate spin cycle. The final boss of IRS debt.
Good old interest.
Good old interest. Up until this point in our deep dive, we have only looked at two things. First, the original unpaid tax balance you owe, and second, the flat fees or percentage-based penalties charged on top of that balance. But now, we introduce the third element. How does the IRS handle interest?
This is where the math goes from punishing to potentially catastrophic. The IRS calculates interest not just on your original unpaid tax balance. They calculate it on the unpaid tax balance, plus the penalties that have been assessed, plus any previously accumulated interest.
Okay, let me repeat that because it is so vital to understand this trap. You are paying interest on your tax debt. You are paying interest on the penalties you were charged for having that tax debt, and you are paying interest on the interest that has already accrued.
Yes.
These three distinguishable amounts are lumped together into one giant snowball, and interest is charged on that entire lump sum.
And it isn't calculated annually or even monthly. It is calculated daily.
Daily compounding interest.
Yes. Every single day, that lump sum grows a tiny bit larger, and the next day's interest is calculated on that new, larger number. It is an incredibly powerful mathematical force. When it is working against you, it is relentless. And here's the crucial warning from our source text, the absolute hardest pill to swallow.
What's that?
Unlike the penalties we just discussed, interest assessments do not qualify for IRS penalty abatement.
Wait, you can negotiate away a penalty if you have reasonable cause, but you can't touch the interest.
Almost never. By law, the IRS generally cannot abate interest. It is statutory. If the underlying tax was owed, the interest on that tax must be charged. The only time interest is reduced is if the underlying tax or penalty is reduced. Otherwise, that daily compounding clock just keeps ticking.
Man. To really grasp the magnitude of this, the author of our source material mentions a book they wrote a few years ago called Money and Finance - What You Need to Know. In that book, they mapped out illustrations showing exactly how interest calculates on an amount being compounded at different intervals.
It's eye-opening.
It really is. Seeing the visual difference between annual, monthly, and daily compounding brings the reality front and center. It is, as the author puts it, mind-boggling. You think you have a handle on what you owe, but that daily tick of the interest clock just keeps pushing the horizon further away.
Which perfectly circles back to the core premise we started with. The only true way to stop the spin cycle is to pay the balance.
So what does this all mean for you as we bring today's deep dive to a close? The ultimate takeaway is clear. If you can avoid IRS unpaid tax balances, interest, and penalties, then do absolutely everything in your power to avoid them. File your returns on time, pay what you can even if it isn't the full amount, aggressively manage your estimated payments throughout the year, and double-check your math or hire a professional to ensure accuracy.
But we also know that life doesn't always go according to a perfectly organized spreadsheet. The IRS actually understands this too. Sometimes uncertain life-changing events happen. A medical emergency, a natural disaster, a sudden catastrophic loss of income.
Life happens.
Life happens. When these severe events occur, you may be able to qualify for an IRS penalty abatement or explore other forms of the hashtag IRS tax debt relief. There are established options and protocols out there if you find yourself in over your head. You don't have to face the spin cycle completely blind.
You definitely don't have to face it alone. And speaking of not facing it alone, I have an incredibly valuable exclusive offer for you listening right now. We spent a lot of time today talking about the severe $245 per partner per month penalties for missing the March 15th filing deadlines for S corporation tax returns and partnership tax returns.
Those are the silent killers.
Exactly. Well, you can completely eliminate that risk right now. Do not wait until the very appointed day of the deadline due date. Reach out to Sands Virtual Enterprise, LLC. They are Atlanta's local, trusted, expert, and experienced CPA firm.
That's amazing.
Yeah. They will take care of you, and they will get your S corporation tax return extension and your partnership tax return extension requested and filed completely for free. Just mention that you heard this offer right here on the Tax and Accounting Ride Along podcast. That is a massive amount of peace of mind, completely free of charge.
That is an incredible resource to have in your back pocket. And as we leave you today, this raises an important question, a final provocative thought for you to ponder. We've just spent this time exploring how mathematically devastating daily compounding interest is when you owe money to the IRS. The speed at which it snowballs is staggering.
It's scary.
But I want you to flip that script in your mind. Imagine if you ruthlessly protected your capital. Imagine if you avoided every single penalty and late fee by simply filing an extension on time. And instead, you took those saved dollars and put the power of daily compounding interest to work for you in your own investments.
I love that.
Every single dollar you save from avoiding an IRS late fee isn't just a dollar saved. It's a powerful seed for your own financial growth. Let the math work for you, not against you.
What a perfect way to reframe it. Thank you so much for joining us on this journey today. We hope this deep dive has empowered you to take control of your filings and steer clear of the IRS bin cycle. Thanks for tuning in to the Tax and Accounting Ride Along podcast. Stay curious, stay proactive, and we'll see you next time.
Well, folks, that's a wrap. Thanks for joining us for another episode of Tax and Accounting Ride Along, courtesy of Sands Virtual Enterprise, LLC. Got feedback or curious questions? Or maybe a topic that needs some airtime? We'd love to hear from you. Connect with us at admin@sve-accountingandtaxes.com or text us at 404-5858513. Also, follow us on Facebook, Instagram, TikTok, YouTube, and LinkedIn for more insights. Catch you next time for more business talks and good times.